guys, JC Parets here of allstarcharts.com, and welcome to the show. What we normally like to do here is three things. The first thing we want to do is make sure there's some sort of educational lesson, right? Something I've probably had to learn the hard way over the years, most likely. And then we want to make sure that we talk about the markets, right? That's what we're here for. What's the market doing? What do we want to buy? What do we want to sell? What do we want to stay away from? What's got our attention? What are we talking about internally? And of course, let's take some questions, right? What do you guys want to talk about? What are you curious about? A lot of traders, a lot of professionals, financial advisors coming to us with questions, and we'll try to address them here. Shout out to StockCharts TV for having me on. Let's get right to it. So the first thing I want to talk about is really today's lesson. And, I want to kind of continue with what we've been talking about in terms of, getting information elsewhere. Today we had our meeting. We have a weekly meeting at 10 o'clock Eastern time with all our analysts. Everybody's in. Some analysts focus on some things and less so on the others. Sean in particular is funny because he focuses on options, right? So he's really most interested in what our end conclusion is. He doesn't particularly care about, why we got to the fact that we want to buy Peloton or short Zoom or whatever it is that we're doing at the time. And a lot of that work has to do with currencies around the world, the US dollar, Aussie, yen. Today, one of the big things that we're seeing this week is, and we'll talk about it in a minute, is Nifty small caps outperforming Nifty large caps. So in other words, Indian small caps are outpacing Indian large cap stocks, which is traditionally an incredible measure and evidence of risk appetite for equities. And we are now breaking out to new 52-week highs on a relative basis in small caps. So anyway, this is where Sean pours himself a cup of coffee. He's not interested in any of this stuff. He's like, so what's the damn trade? And ultimately, we're buying this platinum stock or whatever it is one of the things that we're buying. But a lot of that has to do with all these other things that we're talking about. And listen, you might be like Sean, and Sean's great because Sean then gets our ideas and then creates option strategies within them and does more implied volatility analysis and things like that. Doesn't so much care about the other stuff, but he trusts that we are doing that work. Obviously, he's in our meeting, so he understands, it's not anything that he's interested in, but for us, it's very, very important. So I just wanted to follow up on making sure that you're getting information in other asset classes. There's so much information there. Another one is the US dollar, which we will get into also. Remember, the US dollar peaked in the fourth quarter of 2016 when stocks started to rip from there, right? Then the US dollar bottomed out in January of 2018 when risk peaked all over the world and stocks got destroyed for a few years. Then the dollar peaked in March of last year. And stocks have absolutely ripped since then. So if you're not looking at these other asset classes, I think you're selling yourself short. One of our clients made an interesting point the other day. He emailed us and said, JC, before I found you guys, I'm going to butcher what he said, but basically it was somewhere along the lines of, before I was introduced to the way you guys look at the markets, I thought that, as it turns out, I was just a goldfish in a little fish bowl, right? And then I realized that there's this massive ocean out there of information and risk assets and more defensive assets and a lot of information in currencies, fixed income, in the commodity universe, international equities that we could then use. Even if you only trade US stocks, which I know is the case for a lot of people, that information is incredibly valuable. So I just wanted to reiterate that because we're literally seeing it. And Sean, being bored to death in our meeting today for a little while, was a nice reminder of that. So that's where the work starts. All right, so let's dive in. I thought that was a good lesson, something we talk about, right? All right, so let's dive in, folks. It starts here. It's not about coronaviruses and vaccines and the death toll or economic unemployment. That's not what this is about. It's about credit. That's what this is about. And the bottom line is it's tough to be overly bearish from any sort of intermediate or longer term perspective on equities or risk assets in general if US Treasury bonds aren't even able to outperform a basket of bonds, right? Treasury bonds can't even outperform a fixed income basket. Like, that's just not the type of behavior that strikes me as, something that would occur right before stocks completely fall apart, right? That's just not the case. It's really, it strikes me as something that happens when stocks should be doing well. And as it turns out, stocks are doing really well. I just want to point you here to a couple of things. This is a year ago, just to compare today to last year. I could show you a bunch of examples, but let's just keep it simple. Really incorporate our recency bias. But this is like that in other peaks as well. The S&P 500 was making new highs into February last year, but treasuries were already outperforming, right? You saw it in the bond market well before that. Granted, as we've discussed, there were a lot of other things saying to get the heck out of stocks. Regional banks peaked in December. We're making all-time relative lows on the regional bank ETF, KRE. We're already getting relative rotation into consumer staples, treasury bonds. You were seeing all of that. Even gold was outperforming already. You were really seeing evidence of risk aversion already well before the S&P peaked. But let's say you ignored all those other things and you just looked at credit spreads. You knew there was a problem. I mean, literally, the ratio between high yield and treasuries were substantially lower than where they were in the fall of 2019 when stocks were doing well. And notice how that's not what's happening today, right? High yield is dramatically outperforming U.S. Treasury bonds. Treasury bonds are the bottom of the barrel in the fixed income world, which makes perfect sense in an environment that money is being put to work into risk assets like commodities, like stocks, right? So I think that makes sense. So if you're Mr. Gloom and Doomer and one of these perma bears got you down, keep an eye on credit spreads because you're most likely going to see a bit, at least any kind of bid. Even when stocks go down, you still don't get a bid in bonds, in treasury bonds, right? It's out of control. There's just no bid in U.S. treasury bonds, which again is not evidence of risk aversion for sure. And then if the duration police comes at you, you let them know that the HYG versus IEF ratio looks exactly the same because these duration nerds. They're like, well, JC, the junk bond ETF is a 9-year, whatever. And, the TLT goes 20 plus. And it's like, all right, fine. But I prefer the more liquid alternative in the treasury bond space, which is why you look at the TLT. But again, if the duration police is going to get all their panties in a bunch, then just show them the EAEF. It looks exactly the same. All right. Here's another look at credit spreads. Again, just as narrow as they've been since the beginning. There's just no activity here whatsoever. Reminds me of like the new 52-week low list. Like there's just nothing going on there. And by the way, which reminds me, if you're going to be looking at the new 52-week low list, there's probably not going to be a lot going on there for a while. So I would look at the 21-day, 63-day lists because you'll start seeing those perking up before they show up on the 126 or the 52-week list. So just kind of keep in mind that breadth deterioration is a process. It doesn't just happen overnight. So keep that in mind as well. All right. So I wanted to go over a few of these areas where we go find evidence of risk being put to work. And it's nifty small caps versus nifty large caps. I'm telling you right now, this is where we want to be looking for risk. If you notice here in 2018, this is when the ratio of small caps in India to large caps peaked. This is when stocks peaked all over the world, right? Granted, the U.S. still did okay for another couple of quarters and then fell apart, but most of the all over the world, China, emerging markets, just everything was falling apart. The U.S. was sort of the one showing that relative strength there. And then notice how when this ratio bottomed, this was in March last year, and it's been doing great. And now we're making new 52-week highs in the ratio. So if that's the case, listen, if you're, again, Mr. Gloom and Doomer, perma bear, and you think stocks are going lower, you want to look for this ratio to roll over back below these former lows. If that's not the case and we're above that, that thesis is just wrong, right? Shorting stocks is irresponsible. All right. And then, by the way, if you want to replicate this ratio here at home, you can look at SMIN relative to INDY, and you're going to get the India small caps versus large caps. They look pretty much the same. You see that? So this is the indexes themselves in India, and then this is the ETFs here in the United States, right? Same bearish to bullish reversal is what we're seeing. All right, so now let's get into the dollar. So, for me, this is the one that's going to be, the heads up that something's wrong. If I try to compare it to see how, because I was getting asked about commodities. you know, because the dollar completely falling apart here, I think will be a tailwind for commodities to continue higher and for stocks to continue higher. Risk assets in general, this is what we're looking at, right? So look at this resistance a decade ago. We broke out, we retested in 2018, and now here we are again. You know, this just isn't something that looks like I want to buy. The trend here is down, and if you reverse engineer sort of this scenario, and here, sorry guys, if you reverse engineer this whole situation, right, and you start looking at things that should be doing poorly in a strong dollar environment, right? What should be doing poorly if the dollar is strong? Probably base metals, commodities, emerging markets on a relative basis. Like these are the things, you know, CAD, Aussie, right? These are the things that remind me of assets and lines that should be going down in an environment that the dollar's going up. And that's just not what's happening, right? We're seeing the opposite. We're seeing strength in CAD, strength in Aussie, emerging markets, new relative highs, commodities doing well, base metals doing well. We're seeing all of those things, which doesn't strike me as an environment that the dollar's strengthening. So when you reverse engineer the situation and you weigh the evidence, I think it's pointing to the dollar continuing lower. And by the way, if you're interested in these slides, just email info@allstarcharts.com, password NIFTY. So info@allstarcharts.com, password NIFTY, and we'll send you the slides. This one's got my attention, guys. This really does. I got to tell you, the strength in silver and platinum is the only reason why we haven't been shorting gold, right? As much as we've wanted to stay away from gold since our targets were hit last August, we haven't really wanted to short it because an environment where silver and platinum are outperforming gold, again, is just not evidence of the type of environment as shorts and precious metals do well. Quite the opposite. So if you equally weight a basket of gold, silver, and platinum, this looks to me like this is happening, guys. This is happening, and we're breaking out. And if an equally weighted basket of silver, gold, and platinum is breaking out to new highs, can gold be too far behind? So for me, the big one is those lows from 2011 and 2012, and then we broke down, then we turned into resistance as it should have been. This was why it was our target, right? This looks like gold, right? This is why it was our target, because that former support should turn into resistance. That's exactly what happened. We tried again, failed again. Now here we are again. The more times you knock on the door, somebody said the other day, it's only polite to knock on the door a few times before just bursting through. I thought that was kind of a good way to explain resistance and support. I thought that was interesting. So kudos, forget who told me, but that was funny. Another thing that I learned over the years, and this is one of those things where when you're in New York and you're just in that environment, surrounded at all times, you just hear things that stick with you. You know, from you hang out with enough smart people at enough bars late enough at night, you're just gonna collect tidbits. And in many cases, I remember where I learned certain things from, like the bigger the base, the higher in space, JC. That's Luis Yamada, who learned it from Alan Shaw. And if you ask Alan, he'll tell you that he learned it from his predecessors. Like, so that goes back forever. You know, certain things like we're not in a reversion to the mean business, we're in a reversion beyond the mean business, right? That's John Roque. Shout out John Roque. You know, understanding the type of environment that we're in and then identifying which tools to use to profit from that environment is very Jeff DeGraff, right? So there's certain lessons that I've learned from certain people. Ralph Acampora, I can give you 1,000 of them. Don't fight Papa Dow. Sector rotation is the lifeblood of a bull market. All those are Ralph Acampora. So I can remember that. This one in particular, I don't remember. But the lesson is essentially buy new 6-month lows within long-term uptrends, right? Buy new 6-month lows within longer-term uptrends. Gold and gold miners last week just made new 6-month lows. In fact, 7 and 8-month lows respectively. So if you think that gold is in a long-term uptrend, which we do, then we want to be buying these new 6-month lows, don't we? Right? That's, you know, again, I'm not telling you, I'm sort of thinking out loud here. What does that mean? I think it's interesting, especially when this is going on. and you got a big base in the equally weighted precious metals index that's breaking out, buying new 6-month lows here is really interesting, particularly if you think that we're in a long-term uptrend in gold, which we do happen to believe that that is in fact the case. So I think, again, really, really interesting stuff. And I think it goes back, not to be Mr. Dollar. Willie always likes to say that people like to talk about the dollar because it makes them sound smart. And he's not wrong, right? And it always sticks with me. It's like, JC, are you trying to sound smart, JC, or are you actually interested in the dollar? And I actually am interested in the dollar here because I really do think it's going to play a big role in all of these commodities that we're analyzing for sure. All right, so what's the trade, JC? Great. It's like Sean, right? Like Sean's like, all right, JC, fine. Enough with the nifty indexes. What are we buying? So this is Sibanye Stillwater. Sibanye. SBSW. It's a gold stock. My understanding is that it's more platinum, if that means anything to you. I don't know if that's true or not, but that's what we were talking about in the meeting today. So Straza mentioned, he knows about, he likes to dig into some of that stuff. $14 billion stock. For me, it's less about any of that stuff and more about the base. So we're looking for a base breakout here. Sean likes the October 25 calls. Volatility is cheap. So we don't have to finance, it's not necessary to finance out and cap our upside accordingly. Finance the trade by selling some out of the money calls and putting on a spread. It's not really worth it. You're not getting much juice. Just go out as far as possible. The next one after October is January. Sean thinks that's a little too far out. So October is the sweet spot. So we're looking at, about 6 months out. It's not bad. So if we're right on this and we do get that breakout, the calls I think will be nice. So we want to be long from an equity standpoint if we're above those former highs. You can see that here, right? We want to be buyers of that breakout. And Sean likes the calls already. Just go out as far as possible. Another one is AG. If we're above those former highs from 2016, I think we can be long, right? I think we can be long. That's a heck of a base. This is one of the leaders out there, for sure. Off the top of my head, I can't think of another one. Look at Newmont. Newmont is pushing down against those new lows. The bids keep coming in this week. It's really interesting, that Newmont. So let's keep an eye out there. All right, so this is the Under the Hood report. So remember, these are stocks that are showing an unusual increase in investor interest. So these can be, unusually high volume relative to other volume, an unusual increase in mentions in social media. It could be insider transactions, big filings, for whatever reason, unusual options activity, right? But for whatever reason, there are more people looking and more investors looking at these names than there were before. So what does that mean? Well, it doesn't mean that much on its own, but what it does mean is that, listen, all these people are looking at this, they're looking at it for a reason. So I want to look at it too, but we'll look at it using our process instead of what other people use. So we'll just create a universe, and then we'll either be like, wow, these people are onto something. There's momentum here. We want to ride this higher. We're going to buy it along with them. Or these people are nuts. What the heck are they looking at? We'll take the other side and we'll short it, right? So what I like about this particular scan is that it's long short. Some of our other scans are only long or only short, depending if it's the short scan, right? This one is long short, so it's really, really interesting because all we're doing is building a list of stocks that all of a sudden more people are interested in. That's all we know about this. It doesn't mean we're going to buy it. It doesn't mean we're going to short it. In fact, 90% of them we don't do anything with. And a lot of them on the list, maybe, I don't know, maybe half are on our radar anyway. Maybe more than half are on our radar anyway. They're already coming up on our scan. So what's interesting is when the stocks come up on the Under the Hood report and they're also showing up on other scans like Dick's Sporting Goods, which showed up on the Under the Hood scan the other day or months ago, and it was also on our Young Aristocrat scan. So when they start, doubling up, it's really, really interesting. I think they even showed up on the Fade the Street scan with low estimates on the analysts. Don't quote me on that, but needless to say, it's a good example. NVIDIA is another one that's been showing up on a lot of our scans. So an interesting name. This one's already taken off. Herc Holdings. The scan came out earlier this week. Herc Holdings. So 73 was the level. We wanted to be long if we were above that. It's already working. I think it goes to 110 And then this one I like. It hasn't taken off as much. We put this out yesterday. Select quote SLQT. If the stock's above 29, I like this long. Look at the relative strength in SLQT breaking out on an absolute basis, breaking out as well. We only want to be long select quote SLQT only if we're above 29 with a target of 37. And, this is a great example of a stock that if it wasn't for us doing these scans, I would have never found this. Like, this is a $4 billion mid-cap insurance broker. Like, are you kidding me? I would have never found this thing ever if it wasn't for our scans. And this one's making new highs, an unusual increase in investor interest, well-defined risk versus reward profile in financials, which we like. The rotation we've liked, obviously. It's been working, so it's in the right group. What's there not to like? Relative strength breaking out, positive momentum, under the hood report, like just check. But most importantly of all of those, let's say it didn't have any of those, the risk versus reward is in our favor. And the probabilities of success, considering it's in an uptrend, are also in our favor. So even with all of that stuff aside, the fact that we have a catalyst, the fact that momentum's in, relative strength, all these things, the fact that we have all of those is great. But at the end of the day, it comes down to, are you trading in the direction of the underlying trend, which increases your probability of success? And is the risk versus reward skewed in your favor? Those are the most important two questions. All that other stuff is great. Don't get me wrong. I'd rather have all those other things, but it's those first two things. It starts and ends there. That's really the bottom line. So by the way, again, if you're interested in these slides, info@allstarcharts.com, password NIFTY, info@allstarcharts.com, password NIFTY. All right, so let's take some questions. Today's questions are, is this it for growth versus value? Great question. Certainly looks that way. Look at a chart of the Russell Growth Index versus the Russell Value Index, breaking down to new lows, completing that top. Think about growth like technology, communications. I shouldn't say not all of them. That's really not true because Disney's in there. Disney is one of the captains of the value team, right? Disney, Berkshire Hathaway, JP Morgan, Bank of America, J&J. Those are the biggest names in value. And what are the biggest names in growth? Apple, Amazon, Facebook, Google, right? Those are the biggest names in growth. So we're seeing serious rotation. It's really interesting. Rotation into emerging markets and international over the United States. Rotation into value and instead of growth, right? These are changes. The market goes through these rotations. It's perfectly normal. We've seen it before. We'll see it again. And I think it's important to pay attention to that. And you look at something like Disney, absolutely ripping. Great trade we've had on JP Morgan too, for that matter. And Sean's all excited about it because he knows that there's all this other work that led us to value and identifying these names like JP Morgan and Berkshire Hathaway and Disney. He's just happy to get the list. He's like, all right, so what are we buying? And then he tries to find the best options trades accordingly. But the trade has been there. So if you sort of think from a portfolio manager's perspective, something like a Disney and a JP Morgan and a Berkshire for that matter is getting sympathy flow from managers getting that value exposure. So think about that. People are like so concerned about the fundamentals, Disney Plus and this and that, and Jamie Dimon and Bank of America, Berkshire, Warren Buffett, blah, blah, blah. Forget all that stuff. It's bigger than that, right? It's flow coming from PMs trying to get exposure into value. That's what that is. So I think it's really, really important to recognize that. We were just talking about that in Clubhouse today. And by the way, if you guys aren't on Clubhouse, get on Clubhouse every day at 11:30. We jump on. I invite some of my smartest friends to come and chit chat about the market, what we're seeing. Great conversations. I learn something every single day. Highly encourage you to do that. Okay, next question. So this is at Clubhouse at All Star Charts every day, 11:30 a.m. Eastern time. All right, so JC, are the generals falling? Does that mean that the army is going to fall as well? So like there's an old saying, the market bellwethers, when you start losing the generals, the rest of the army is going to fall. But if you're suggesting that these mega cap names like Apple and Amazon and Microsoft and those and Google that have been struggling are the generals and the rest of the army is going to fall apart, I think you're selling yourself short by identifying that those are the only generals. There's other generals. Berkshire Hathaway's not a general, right? JP Morgan's not a general. ExxonMobil, Chevron, these are some of the biggest companies in the world. They're making new 52-week highs or all-time highs in some cases. So I'd argue some of the generals are falling apart, but can you blame the generals that the army, their armies are so strong, right? Is it the generals' fault that the armies are so strong, right? Like, that's how I look at it. Small caps, transports, mid caps, international, like all the non-generals, if you will. The fact that they're so strong, is that a bad thing? Number one. Number two, it's not all the generals. It's a few of the generals, number one. They're not falling apart. They're just now breaking out. Which leads me to just another topic that if the market's going to go higher, it's going to need those to participate. So passive investors are getting destroyed. Passive investors have been getting crushed. Like, we're talking 2,000, 2,500 basis point, right? Underperformance. Like, these are serious, serious losses for passive investors. So I hope you guys are watching this. You know, this, people who've been pounding the table on passive investing, like, this is no bueno for them. Serious underperformers, as these mega caps and huge components of these passive investments are just not doing anything while everything else is ripping. You know, if you miss that small cap move, like, you know, that hurts big time. Mid caps, all that stuff. So passive investing, another loss for the passive column. Anyway, for US dollar, what does it mean for lower rates, right? So there's like, I don't know where this came from, that like the US dollar and interest rates have to move together. Like that's such bullshit. Like, who came up with that? Like, it's like, I don't know if they're like professors or like economists or something like that, but like they must be very confused people. I never understood that. So like yields in dollars, like treat them individually. You know, sometimes, you know, in some environments, bonds and the dollar are going to move together, particularly like in risk-off environments, you know, where yields and the dollar are going to trade inversely, right? Particularly in risk-off environments. We've seen it before. And then there's other environments where the dollar's rallying and yields are rallying along with it and bonds are selling off. Sure, that's happened before for periods of time. And most of the time, there's just nothing there. There's nothing there. And like Willie always says, people who like to talk about the dollars probably because it makes them sound smart. And that's true. But in this case, I'm not trying to sound smart. I really do think the dollar. So I just want to emphasize this one more time. Let's go back up there one more time and just talk about the dollar, because we do have a couple of seconds. This is what it is. I mean, this is what I'm most interested in right now. Like, JC, what are you looking at? Like, what's got your attention? I think it's this. How this resolves, I think, is going to be big. I think this upside resolution in nifty small caps over the large caps, I think that's huge. You know, those of you following along know that we've been pointing to this, looking for a breakout, like saying like, hey, wow, that would be a big, you know, a big event in terms of risk if nifty small caps were able to, you know, outperform nifty large caps and all that stuff. So that's how I look at it. All right, guys. Again, if you're interested in, you know, what we have to say, go to allstarcharts.com. You know, you can find me all over the interwebs at allstarcharts on Twitter, on StockTwits, Instagram, YouTube, Clubhouse now. All the kids are on Clubhouse. We're having a lot of fun every day at 11:30 a.m. Eastern time. Check it out on Clubhouse. If you want these slides, email info@allstarcharts.com, password NIFTY. And to all of you guys out there, have a glass of champagne before dinner. It's good for you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.